Banks, why are you still here? That's the question we're going to talk about today. My name's Tim Tyler. I'm a senior industry principal at Finastra covering corporate banking. And I'm going to spend the next 25 to 30 minutes exploring that question and understanding perhaps what role a corporate bank has to play in the modern world. Joining me on this discussion is Jonathan McPhail, Global Innovation Lead at Finastra, and also Joost Bergen, founder of Cash Dynamics and business advisor. Gentlemen, welcome to both of you.
Thank you.
Joost, I'm going to turn to yourself first, I think. Before we get into the meat of this question, it'd be interesting, I think, to understand exactly what we mean by corporate treasurer and the type of organization that they're going to be working for. So, Joost, what's your view of that at the moment?
Yeah, thanks, Tim, for that question. So, before answering that question, I think the Treasury is a very specialized financial function within large corporate organizations. And I think when we talk about the treasurer, we talk about a person, we talk about the Treasury department as being an organization, but I think we also should look at the Treasury tasks. And I think the Treasury tasks, much more relevant than look at the organization, because that's what most companies do, and also companies that don't have, let's say, a formal Treasury organization. But I think there are four key areas where Treasury will focus on. I think firstly is they need to manage the company's financing needs, right? And also keep access to the financial markets. Secondly, it is really monitoring, managing and mitigating the financial risks. And I think the cybersecurity is getting more and more important there, particularly during the whole pandemic. We've seen a lot of malware attempts whereby the criminals try to attack the Treasury department or the payment execution area, because that's where real cash flows flow out of the organization. Thirdly, it is really about cash and liquidity management. And I think how to manage that overall by cash flow forecasting, by understanding what the dynamics really is of the cash. And I think fourthly is bank relationship management. Because they manage the bank relationship, not only for today, but also for the refinancing needs. They need to have a good relationship with this community. And of course, they are the procurement officer of financial services. So I think it is quite broad aspect, what treasurers do and what the Treasury tasks are, even though you don't have a formal Treasury organization.
Do you think as well that we talk about corporates, and I think perhaps sometimes it's a bit of an overused word, perhaps. When we talk about corporates, are we talking about the larger enterprises, or are there parallels as well as we perhaps go down to some of the smaller entities? What sort of market segment do you think this is most applicable for?
Yeah, I think so. So very often you look at market segments, talk about size, right? Size in terms of revenues and size in terms of number of employees. I think I already mentioned what are the core areas or core activities they do. So that's why I talk about treasury activities. When you're a smaller company and you have a very international supply chain or value chain, you import, you export, you have permanent establishment, you can be already extremely complex. And then you need to do many of the treasury activities I just mentioned. But when you are a domestic utility company, then of course this has a different dynamic. So I think we should look at the dynamics of the organization, what also the role and responsibility and accountabilities of treasury would be. So I think there's much more multidimensional view to take there than just size.
So perhaps not to pigeonhole it quite so much, but actually look at what's needed on a per enterprise, per entity basis. And Jonathan, turning to yourself, taking that on board, if we were to break down the bank, what do you think the sort of role a modern bank should play in that relationship with corporate treasurers today?
I think that's also an interesting question, Tim. The role that financial institutions really take with their corporate customers, I'd say, stays in the traditional guide rails of providing capital, both in the liability side with accounts and standard accounts, also obviously importantly with lending. I think the way in which those services are delivered is really what's changing, and that's where you can use the word broken down to quite a good extent.
And I mean, so we say breaking those down into I guess, into component pieces. When we look across a corporate bank, and I'll throw this open to both of you, but perhaps you're coming to yourself first. How do we think banks are performing? And we could be open and honest here, you know, it's...
Yeah, yeah, I think, no, so when you look at banks, so bank is actually a combination of different models, right? And as a company, you should fit in a model to be served. So certain banks do have a certain models and certain appetites to absorb certain risks, and other banks do have another risk. So that's why you can't really compare. And I think what Jonathan already said, every bank have a different mix of assets and liabilities. Of course, will also drive what type of companies or type of clients they are really looking at. But I think when you look at banks in general, they deal with a lot of legacy infrastructure. Many banks are not designed per se to deliver the value, provide the experience that their clients expect nowadays from them, right? So we move from batch processing to real-time processing. Companies are looking for integrated solution that also bridge, let's say, the different business units between financial markets, corporate banking, asset management. So how do you provide all that data on such a way that's also easy to incorporate in the company's own infrastructure? So I think there are quite a lot of challenges there for banks to bridge. And of course, and the capital, as Jonathan mentioned, do we still have the capital to also to provide the lending companies are looking for? As particularly in Europe, the capital market is not really as developed as we see that in the US. So banks are very important for the corporate space or the smaller company space.
So I would agree, banks are very important. I think, you know, perhaps a more pointed look at Jonathan to get an assessment of how banks are doing. I mean, clearly they're there, they're servicing a need, they're providing their balance sheet. Are they going beyond in the way that they could be going beyond at the moment?
I mean, I'd say bluntly no, and it's for a reason that Jos has already mentioned. A lot of these financial institutions have come together over the years through mergers and acquisitions, and that's meant that the infrastructure, I can safely call it legacy infrastructure that they serve their clients with, is often based on siloed applications that look at a particular product line. So there's no view across those products, even in a simple way, between the liability side, so cash management, liquidity, and the asset side for the bank, so the lending. And so without that ability to bring together those different silos, they're not able to serve their customers in a way that they need in what is increasingly a real-time world, where cash and visibility on cash and visibility on cash positions, both what you have today, but also what's coming up in the not too distant future, is key.
Can I just pick on that phrase, real time? There's a lot of talk about real time, and, you know, obviously we've seen the shift to particularly domestic and local payments being real time. Do we think there's a real need for real time across the bank to service clients, or actually it's more near real time? It's today which is important as opposed to this minute. What's your view on that?
Yeah, I think in this context, you know, we're not talking about equity trading or FX trading where you have to have your machines in the exchange right next to their service. We're really talking about near real time. So, you know, the same day, the same hour, the same half hour. You know, that's really what we're talking about, as opposed to having a check clear in 5 days or 3 days or whatever we had in the past.
And just, I mean, from the work that you do across both corporates and with banks, is your experience of that dynamic the same? The fact that, you know, I think we talk about seamless integration and the fact it's got to be from front to back instantly, but do you think perhaps rather than real time, timely is a better way of describing what banks need to be doing for their clients?
I think the business as such require more and more that it becomes close to real time, right? We want to understand now what's happening, and I think we can make a difference between the reporting cycles within companies versus a monthly, quarterly cycle. These numbers you cannot trust as a treasurer, right? You really need to know what's in it today and what is going to expect tomorrow. And I think when you look at traders, for example, they really need to know, did I receive my payment? So can the truck leave our premises? So this kind of business needs already required, but still do require, let's say, close to real time. But I think a lot of new business models also require much more almost close to real-time data exchange to be able to operate. And if that is and that, of course, it's particularly in the operational processes, in the FX you do business in the transactions you do, and the transaction, of course, also triggers, let's say, securing some services you are going to provide, or shipping the goods from out of your e-commerce store, right? And so there, I think the business requires more and more also instant transaction processing. Yeah. So I think it is accelerating.
I think there's some good points you raise there, in that it goes beyond the data. There are linked physical processes within the corporate as well as within the bank that are dependent upon these outcomes. And I mean, Jonathan, turning back to yourself, you previously mentioned about breaking down the bank and the fact that banks often have legacy systems, legacy processes. Are these suitable for modern day banking? Do we need to break those down further into component parts, or, you know, are we encumbered at the moment with that legacy, which is ultimately going to slow down what we do?
I think that's a really interesting question that I think is driving everything in financial services at the moment. So I think we really have to start looking at the next wave of innovation, and that's clearly around banking as a service. So maybe to start with a definition of what that is, so that we know what we're talking about. That's really simply, it's a model in which the licensed service provider, so traditionally the bank, will integrate their banking services directly in the products of a non-banking business. So you might think, for example, an airline might start offering a current account to their customers to bring in some more loyalty and have more of the overall wallet share for that particular customer. And they can offer them a current account. They can brand it with their airline, but they don't have to run any of the licensed services, because that's essentially provided as a white label by a licensed provider, so a bank. And so if we take that view of what banking as a service is, and we consider the providers who are now coming into the market, I think it's certainly the direction of travel. Although to date, we may have seen more of this in the retail space, where you might have a telco who starts to provide debit cards and credit cards and accounts and some simple forms of lending. I think that in the not too distant future, we'll definitely see this more in the corporate space with products like cash, virtual accounts and liquidity. And so for a start, I think corporates are going to consider how they interact with their financial institutions, or maybe not their financial institutions. So who are they buying services from? So that's the first consideration.
Well, I mean, let's speak to that point before I turn back to yours. Who are corporates going to be buying their financial services from? And do we think they mind? And what I'm thinking of is, in this disintermediated market, and we see it in the consumer space already with insurance, for example, on comparison sites, you'll go for the lowest price that meets your particular requirements. The actual name, you're not overly that bothered with. You might look at the sort of like the trust score that goes behind it. Do we think corporates will go down that route, or do you think there's more behind what a corporate bank provides that a corporate itself will look to?
Well, I'd say that there's certainly that first level. I think the corporates will start buying financial services from from other providers, especially if you look at payments. So there are more modern providers who you can start to embed payment services within the corporate's process for, right? So they may start to buy that from non-traditional providers. But then I think it's interesting if maybe you turn that whole model on its head. So those financial institutions are essentially going down the platform business model. The platform business model being where they expose what was previously internal to them to the outside world. So in this case, non-banks, so they can create financial products based on the services the bank previously only had internally. So yes, I think corporates will buy more and more from non-banks, but provided by at the end by bank. But conversely, if you think about the end-to-end supply chain or how corporates interact with smaller companies, maybe something they need to consider also is how does that model apply to them? So what services and offerings do those companies provide in Treasury? So how they manage those points that you just mentioned earlier, risk management, managing the cash and the funds flow, getting a visibility on those. What services do they think they offer over which are offered in a much better way than the competition, for example? Could they start to expose and embed in other providers? And the reason for embedding that, just before I hand back to Tim, is really about adding additional revenue streams. So I know it's not necessarily the main focus of the finance teams, but how can they start to use their products and services to either add or boost, add new revenue streams or boost existing ones with those services and offerings that they already have?
So if I was to distill that down, it sounds as if on two fronts, it's breaking down the components and distributing those almost. Some of them remain in the bank, some go out to distributors, brands, etc., to build upon what the bank can provide. And on the other side, it's also thinking about, as we look to the future, planning what you build, whether it's process, technology, workflow, with as a service in mind. Because if you want to deliver the best internally, you might be able to turn that around and deliver it externally as well. Jost, one of the things that springs to my mind off of the back of this, and particularly as we see, for want of a better word, the fragmentation, if you like, of financial services. We started off with the question about banks, why are you still here? But in that fragmented arena, what is the bank bringing to the party? You know, what's the raison d'etre, if you like, of the bank being there now?
Banks are still seen as the trusted party in that whole value chain, right? So they have their balance sheet, they have access to central bank money, they are regulated in a very strict risk and compliance framework with very strict capital requirements. And if you like it or not, I think that's important to get the machine moving, right? So I think what Jonathan just mentioned, I think that's an interesting peek towards the future. It's almost like when you design something for your own organization, do that also have also in mind that you can venture out that activity as a separate business line or even a separate company. But I think in many of these structures, at the end, you still need a bank, right? And of course, you can look for other providers for financing, institutional investors, but at a certain moment you need to settle a transaction through central bank money. So there's always a bank, very often a bank component in there. So I think up till today, I don't really see that banks will not play a role, but of course you see in many instances that banks get this intermediated by other providers. I think in certain countries in Europe, factoring is done by many parties and not just by banks. And factoring is a very important mean for companies to generate liquidity. But it is a risk management liquidity product, right? Or services, which you need capital for that. So is that the bank? So I think we see many different areas. I think the whole FX trading or FX settlement, there are a lot of companies which are not non-banks and provide that to small businesses, and also larger companies make use of them. But I think when you look at a bank is always, I think most of these services, very often the bank can also always provide, I think, the most range of currency pairs. I think these niche players only pick and choose certain currency pairs. So
they choose the path of least resistance, I guess, don't they? You know, that they take the low-hanging fruit.
Exactly, the pie that will give them the highest benefits. Yeah, but I think you see a lot of other industries that are going to move towards financial services. I think what Jonathan said. I think it is banking was always quite an isolated industry. You see it is opening up, right? It is opening up towards other industries, and not just by the incumbents, but by, let's say, new kids on the block.
So is there an element of semantics in this, do you think? And what I mean by that is, you know, we have, I'm sure, in our minds a traditional view of what a bank is, but fundamentally, I think what you're saying is we just need an entity which is backed by a license with a regulatory regime around it. In all other shape and form, it need not look like what we historically have looked to a bank to be. Would you agree with that?
Oh yeah, absolutely. I think when we look 20 years back or only 10 years back, a bank was an institution and they had branches. We see many neobanks nowadays that don't work with a branch, they work with an app. That's the only way they interact with their clients. And they go up to the value chain also to SMEs and larger businesses, including the small corporates. So I think that is dramatically changing, just like 5 years back, right? Before the smartphone, I think many things are changing. And the question is, do we see there be such a rapid change at the moment, where we get many new providers? Look at the whole e-commerce world, right? What's out there in terms of selling and converting customers into paying customers. So there's a lot going on, and that's, I think, and technology makes that possible. I think data is extremely important to manage the business, monitor the business, manage the business. And I think that all comes together in that full value chain where financial services is part of. And I call it financial service because it can be also non-banks or other providers.
No, absolutely. And
yeah.
I mean, Jonathan, turning back to the point you made using airlines, I think it was, as an example. I mean, do you think it actually makes logical sense for banks to start opening up their core activities and externalizing it out to others as a service and letting others do what could be actually the challenging bit, which is customer acquisition? You know, if you go with a brand such as a major airline who often run credit cards at the moment, converting that over to current accounts, you know, they've got that trusted relationship with customers. Let them go and handle that part, and you just provide that financial service back into them.
Yeah, absolutely. I think that's completely the way financial services will go, and that's, you can view that from two perspectives from the bank side. One is they're being disintermediated. Yes, they no longer necessarily own that relationship, but conversely, that provides two benefits. One, that customer journey, the investment in building that out is no longer their problem, and that becomes the airline in that example. They don't have to worry about who interacts with, you know, which button at what time of day and what the conversion rate will be like. They've essentially outsourced that part of the problem to the brand. But it means also on the positive side as well is that they have the ability to scale, so they don't have to worry about how many people walk past their branch or even more recently how many people go use their app. They can find as many ways to scale their product and taking that to market as they can imagine. So I think for those who embrace it, I think there's more upside and making yourself more relevant than there is downside in being disintermediated.
Thanks, Jonathan. Now, Jos, I'm going to turn to you because I want to sort of like almost swing this fully round. Obviously, we're here talking as part of the ACT conference today, and I'm just thinking if I was again, using the term corporate treasurer with some of those loose definitions that we touched upon earlier, what sort of impact do you think this has for someone responsible for those four categories you described in, in terms of risk management and liquidity, etc. When they're looking out to the market, looking for a vendor, perhaps they're issuing their own RFPs to financial organizations. Does this have a huge impact on them, or does it just give them more choice?
Yeah, I would almost say the future will tell us. But I think one thing to this equation, I think the financial column of organization as such is not the one that initiate big changes, right? So I think the changes really need to come from the business. And I think the finance and treasury, they will add value to the business. So they will help the business to grow. So I think when we look back and we look, for example, to supplier finance, this was really initiated by procurement, right? Procurement was looking, how can we help our also long tail of our supplier portfolio to help them in terms of liquidity for a certain price. And it was not initiated by finance, but when procurement was looking at that, finance, of course, helped to structure that further. When you look at export finance, I think that is the business. So I think this has to drive out of the business and then picked up by treasury. So I think to Jonathan's point, when you are an airliner, I think you can initiate a discussion with your commercial folks already. So what are the alternatives? And let's have a look into this, because these are opportunities and possibilities which we see in the marketplace. Because as a treasurer, I'm also the buyer and I procure financial services. So I know what's happening, right? Probably much better than my business colleagues. So,
and sorry, go on, Joost.
Now, I think risk management, working capital improvement, liquidity efficiency, I think these are the terms which are very important for all companies. I think access to finance. Don't forget, a lot of companies are not leveraged. They don't have that. So their equation in towards bank relationships or to the capital markets already different, right? It's much more looking for standby facilities, right? That they can use when there's a requirement for it. So I think we should probably look at the operational process, what's happening there, what's the business, what is the business plan, what is the sales and operational planning, how does it integrate with finance, and how can we support that as finance people and treasury specialists in that aspect from how can we help there. I think that's where it is. But one thing, cybersecurity, I just want to mention it one more time. All we do and opening up and we do new businesses, it also makes us more vulnerable for cybersecurity risk, which should be properly managed as well. And also when you have an e-commerce franchise, you are collecting funds. You need to understand who your clients are. You need to understand the risk of anti-money laundering. So there are quite of other areas which you should explore as well with your business, I think, as a treasurer. So Tim, is that a question? Is that an answer on the question? Because it was
yeah, no, look,
a long answer.
Yeah, look, I think so. I mean, I'm going to turn to Jonathan as well on a similar basis, in as much as it sounds as if, banks are actually going to enable themselves to get in front of more customers, perhaps across different segments and different industry verticals when we look at corporate banking. And from the corporate side, it looks like they'll have more choice, but they've also got to mitigate the potential risk there. If there was a message that you were to put to corporates coming and looking into this new future of how they provide or how they service their own financial needs, what do you think it would be in terms of looking to that market and seeing perhaps all of these different access points to financial services? Is it, that the license has to be there somewhere, so a bank somewhere in the chain is still necessary, but on the other hand, take advantage of all the different providers because everybody's looking to gain the maximum from internal process economies of scale, exposing this all out with technology now enabling that?
I think that where you finished there was exactly the key point. So as you look to improve your processes or consider how you run your business going forward, is really do that in a way that is open. And so that means that you can consume the services that you need from the financial institutions of choice, or be they banks or non-banks, in a way that's as easy to select and integrate and incorporate within a process as possible. And that also means that you can start to consider, again, as mentioned earlier, what are those services that you could then potentially start to expose out to a third party? Because if you consider just a simple process like acquiring another company or divesting a particular part of a company, that almost means that you're a third party provider of treasury services already. So both with the way you operate with your bank and the way you operate internally, think about what is the service that is being that is required, and what is the most open and transparent way to provide that, but with the key being, as you just mentioned, with security as the key consideration, and what's the impact of being open.
And I think a great example of that in a banking world is probably Amazon and AWS, Amazon Web Services, how they built it for an internal need, but to expose it externally as well, and it's multiplied from there. But look,
Exactly.
it sounds very much as if there is still absolutely a need for banks, but they're being surrounded by larger ecosystems, I think, which is becoming enabled by banking as a service. And as corporates look to consume that and modify and build out their own internal flows accordingly, they too should look to that sort of AWS type model, if you will, where when we build what we need, if we build it in such a way, we get options further down the line in terms of perhaps spinning this out externally. Now, look, to both Jost and also Jonathan, thank you for taking the time today. We've run out of time to talk on this topic, although I feel we could have quite easily carried on. For those that have been watching, I encourage you to visit our virtual stand at the ACT conference, where you can get access to our recent report, Beyond the Relationship Model and Cash Management Reimagined, which touches on some of these ever-changing events that we're seeing. And likewise, you can get more information there, and we hope to be able to speak with you again in the future. But Jonathan and Jost, for now, thank you very much.